with a pair of price target hikes for Netflix. Pivotal Research are raising its price target to a street high of $1,600 from $1,350. The firm keeps its buy rating on shares, saying the streamer's goal of a $1 trillion valuation by 2030 is reasonable. Meanwhile, Wells Fargo raising its price target to $1,500. It says high-value short-form content could be Netflix's next big move. Well, it's time now for Options Corner, and joining us to take us through a deeper look at Netflix is Rick Ducat, lead market technician. Very good morning to you, Rick, and happy Friday. What trends are you seeing on the chart there?
Yes, good morning. Strong outperformance from Netflix versus both its communication sector and the S&P 500, up about 80% during the past 52 weeks. And when we look at our candle chart, we can see here that Netflix has been traveling upward here. We crossed above these old highs that we established here back in February near 1064. From there, we had a W-shaped recovery here. Held up a lot better than many other stocks during the tariff-related news cycle here, but eventually broke back above those old highs and formed a upward channel type shape here. However, slowing down a little bit, we can see when we look at our RSI, the momentum study here, we saw a little bit of bearish divergence despite the RSI going into that overbought area, and then we broke lower here, now kind of slowing down a little bit.
Good stuff, Rick. Thank you so much for that. Rick Ducat there talking us through the technicals. Now to take us through an example trade is Tom White, Senior Options Contributor. Tom, good morning to you. So nice to chat to you. How would you set up an example trade after today's price target hikes?
Yeah, if you look at this stock, just below those all-time highs, as Rick mentioned on the chart, it's been trending higher, getting these price target hikes. It's a product nobody's going to be canceling anytime soon. It's kind of taken over as far as streaming goes. So I looked at this one a little bit more cautious. They report earnings on the 17th of July. So I want to avoid that earnings event in case there's some additional volatility in there. So with some short-term positioning here, I went out to the July 11th weekly options. It's about 3 weeks to expiration, 21 days on this example trade, where I'm going to look at selling a neutral to bullish put vertical that takes advantage. It's directionally biased to the upside, right? But it's still giving me a little bit of a cushion to the downside, giving me a better probability of success. So in that July 11th weekly cycle, we're going to sell the 1200 strike put. Stock's going to open up here about 1228. So it's out of the money to the downside. And then against it, because I want to stay risk defined, we're going to buy the 1180 strike put. So a short $20 wide, neutral to bullish put vertical. You're going to collect roughly about a $5 credit if the stock opens up here around 1228. So what does that mean? Well, I can make $500 on this spread, but I can lose $1,500. But I'm not going to lose $1,500 unless it goes back below 1180. Now, my break even to the downside where I start to lose money is going to be 1195 to the downside. That's nearly 3% below the current share price. And you've got a probability of that short 1200 strike being out of the money at expiration of about 65% if the stock opens up here a little bit higher than where it closed on Wednesday. So you're still giving yourself that probability that's higher, about 65%, that's going to be out of the money, which is what you want. And you profit in 3 out of 4 scenarios. Stock goes higher, stock stays where it is, and it can even go lower. You just want it to remain above that break even of 1195.
Awesome stuff. Thanks so much for that, Tom. I'll talk to you a little bit later throughout the trading day.